Imagine waking up in the morning and checking the news. You hear that a company's stock price has surged overnight. Later, on your way to work, you notice a new store opening in your neighborhood, a brand you recognize from advertisements. In the evening, a family member mentions how their retirement savings have grown, thanks to investments in the stock market. Though it might not always be obvious, the stock market plays a role in many aspects of daily life, shaping economies, influencing businesses, and even affecting personal financial well-being. At its core, the stock market is a place where people buy and sell pieces of ownership in companies. These pieces are called stocks or shares. When someone owns a stock, they own a small fraction of that company. This system allows businesses to raise money to expand, develop new products, hire employees, and improve their operations. In return, investors who buy stocks have the potential to earn money if the company does well. This creates a cycle where businesses and individuals both benefit. A growing company can contribute to job creation, new opportunities, and innovation, while investors can see their money grow over time. For ordinary people, the stock market is not just something distant that only concerns financial experts or wealthy individuals. It directly impacts jobs, businesses, and long-term financial security. Companies that perform well can expand, leading to more employment opportunities. When businesses struggle, stock prices fall, investors become cautious, and companies may slow down hiring or even lay off workers. The health of the stock market is often a reflection of the broader economy. If the market is booming, it usually means businesses are thriving, consumers are spending, and economic growth is strong. On the other hand, a struggling stock market can indicate economic trouble ahead. One of the most important ways the stock market affects daily life is through retirement savings. Many people, whether they realize it or not, have a portion of their money invested in stocks through pension funds, retirement accounts, or investment portfolios. These funds are managed by financial institutions that invest in a variety of stocks, allowing people to grow their savings over decades. When the stock market performs well, these retirement accounts grow, helping individuals secure their future. If the market declines, it can cause concern for retirees or those planning for retirement. This is why long-term stability and smart investing strategies are crucial for financial security. The idea of a stock market has been around for centuries, evolving over time to become the complex system it is today. In the past, businesses relied on wealthy individuals or banks for funding. As trade and commerce expanded, people realized the need for a more organized system to raise money. The first stock exchange was established in the early 17th century in Amsterdam, where the Dutch East India Company issued shares to the public, allowing investors to take part in its profits. This concept quickly spread to other countries, leading to the development of major financial centers. Over time, stock markets became more regulated and accessible, allowing more people to participate. Today, stock markets operate in a highly advanced and interconnected way, influencing global economies. While it may seem complex, the basic principle remains the same. It is a marketplace where businesses raise funds and investors seek opportunities for growth. The stock market is not just about numbers on a screen or headlines in the news. It is a fundamental part of economic progress, shaping the world in ways that touch everyday lives. Understanding how it works is not only beneficial for investors, but also for anyone who wants to navigate the financial world with confidence. Imagine you walk into a bakery that makes the best bread in town. The owner, who started the business years ago, has worked hard to build a loyal customer base. The bakery is popular, but the owner dreams of expanding, opening new locations, upgrading equipment, and hiring more staff. However, expansion requires money, and the owner does not have enough savings to fund the growth alone. One option is to take a loan from a bank, but loans come with interest and the pressure of repayment. Another option is to sell small pieces of ownership in the business to outside investors who are willing to contribute money in exchange for a share of future profits. These small pieces of ownership are called stocks. A stock represents a fraction of ownership in a company. When someone buys a stock, they become a shareholder, meaning they own a small part of that business. If the company does well and makes more money, its stock can become more valuable, and the shareholder can benefit by selling it at a higher price than they paid. Some companies also reward their shareholders by distributing a portion of their profits through payments known as dividends. This makes owning stocks an attractive way to build wealth over time. Not all companies sell stocks to the public. Some businesses remain private, meaning their ownership is limited to a small group of individuals, such as the founders, family members, or a select group of investors. Private companies do not trade their shares on the stock market, and their financial details are not publicly available. Many well-known companies, including large family-owned businesses and startups, operate privately for years before deciding to expand by selling shares to the public. When a company decides to sell its shares to the public for the first time, it goes through a process called an initial public offering, or IPO. This process allows a company to list its stock on a public exchange, such as the New York Stock Exchange or Nasdaq, making it possible for anyone to buy shares. Before an IPO, the company works with financial experts to determine how many shares to sell and at what price. This decision is based on factors such as the company's financial health, growth potential, and market conditions. Once the shares are available to the public, anyone, from large investment firms to individual investors, can buy and sell them on the stock market. The main reason companies go public and sell shares is to raise money. Instead of relying solely on bank loans or private investors, they can generate large amounts of funding from the public. This money is often used to expand operations, develop new products, enter new markets, or pay off debts. In return, investors who buy shares hope the company will grow, increasing the value of their stocks over time. Selling stocks also benefits the company by increasing its visibility and credibility. Being publicly traded means the company must follow strict financial reporting rules, making it more transparent to investors. This transparency can build trust, attract more investors, and improve the company's reputation. For shareholders, owning stock means sharing in the company's success, but it also comes with risks. If a company struggles or fails to meet its financial goals, its stock price may drop, and investors may lose money. This is why people who invest in stocks carefully analyze companies before buying shares, considering factors such as profitability, industry trends, and management decisions. Understanding what a stock is and why companies sell shares is essential to grasping how the stock market works. Stocks are more than just numbers on a screen. They represent real businesses with real goals, challenges, and opportunities. By investing in stocks, people are not only looking for financial returns, but also participating in the growth of industries and economies. The stock market is like a vast and busy city where different people play different roles to keep everything running smoothly. Some are here to grow their wealth over time. Some are trying to make quick profits. Some are raising money for their businesses, and others are working behind the scenes to ensure that everything happens fairly and efficiently. Understanding who participates in the stock market is essential, because every action, every transaction, and every change in stock prices is influenced by these players. Each of them has a specific role, and together, they create the complex yet fascinating world of stock trading and investing. Investors are at the heart of the stock market. They are the people and institutions that buy stocks with the goal of making money over time. Some investors are individuals who set aside a portion of their income to invest in stocks, hoping to grow their wealth and secure their future. These individual investors include ordinary people saving for retirement, parents investing for their children's education, and young professionals looking to build long-term financial security. Some of them prefer to invest in well-established companies and hold onto their stocks for years, trusting that their value will increase over time. Others take a more active approach, frequently buying and selling stocks based on market trends. Alongside individual investors, there are large financial institutions that invest enormous sums of money in the stock market. These institutional investors include pension funds, mutual funds, and insurance companies, all of which pool money from thousands or even millions of people and invest it on their behalf. Because they manage vast amounts of money, these institutions have the power to influence stock prices and market trends. Their investment decisions are often based on deep research and analysis, and they can either stabilize the market by holding onto stocks for the long term or create volatility by buying and selling in large volumes. Hedge funds are another category of investors, but they operate very differently from individuals and institutions. These are private investment funds that use aggressive strategies to generate high returns for wealthy clients. Unlike traditional investors who focus on steady, long-term growth, hedge funds often take risks by betting on stock prices going up or down, using borrowed money to increase their potential profits. Their activities can add unpredictability to the stock market, as they react quickly to news, economic data, and trends, sometimes causing sharp movements in stock prices. Traders, unlike most investors, are focused on short-term gains. Instead of buying stocks and holding onto them for years, traders buy and sell stocks rapidly, sometimes within minutes, hours, or days. Their goal is to take advantage of small price changes and make a profit from frequent trades. Some traders, known as day traders, close all their positions before the market closes each day, ensuring they are not exposed to risks overnight. Others, called swing traders, hold on to stocks for a few days or weeks, looking for opportunities in price fluctuations. Trading requires quick decision-making, a deep understanding of market patterns, and often the use of advanced technology to execute trades at the right moment. Unlike long-term investors, traders are less concerned about a company's overall success and more focused on short-term price movements. Companies themselves are also participants in the stock market, but their role is different. Instead of buying and selling stocks, they issue them to raise money. When a company needs capital to expand, develop new products, or invest in research, it can sell shares to the public. By doing so, it gives investors the opportunity to own a part of the business. In return, the company receives funding without having to take on debt. However, becoming a publicly traded company also comes with responsibilities, such as regularly reporting financial results and being accountable to shareholders. If a company performs well and grows, its stock price rises, benefiting both the company and its investors. If it struggles, its stock price may fall, making it harder to raise more money in the future. Brokers and market makers act as the bridge between buyers and sellers. They ensure that when someone wants to buy a stock, there is a seller available, and when someone wants to sell, there is a buyer. Brokers provide the platforms and services that allow individuals and institutions to trade stocks, whether through traditional brokerage firms or online trading apps. They execute orders on behalf of investors, earning commissions or fees in the process. Market makers, on the other hand, ensure there is always a continuous flow of trading by actively buying and selling stocks. Without them, the stock market would be much slower, with fewer transactions taking place. Their role is crucial in keeping prices stable and ensuring that stocks can be bought and sold easily at fair prices. To maintain order and fairness in the stock market, government regulators oversee all activities to ensure transparency and protect investors from fraud or manipulation. In the United States, the Securities and Exchange Commission, or SEC, is the main regulatory body that enforces rules to prevent illegal activities, such as insider trading and market manipulation. It requires companies to disclose financial information so that investors can make informed decisions. Other countries have their own regulatory agencies, all working to create a stable and trustworthy market environment. Without regulation, the stock market could become a place where dishonest practices thrive, making it unsafe for investors and damaging economic stability. Each participant in the stock market plays a unique and important role. Investors provide the capital that fuels business growth. Traders create movement and liquidity, making it easier for stocks to be bought and sold. Companies raise money to expand and innovate. Brokers and market makers ensure smooth transactions, while regulators maintain fairness and trust. Together, these players create the dynamic system that allows businesses to grow, individuals to invest in their future, and economies to develop. The stock market is not just a place for numbers and transactions. It is a network of people, businesses, and institutions all working together, shaping the financial world in ways that affect everyday life. Imagine walking into a giant marketplace where people from all over the world gather to buy and sell things. Instead of fruits, clothes, or electronics, this marketplace is filled with stocks, small pieces of ownership in companies. Every day, millions of people visit this marketplace, looking to buy stocks they believe will increase in value or sell stocks they no longer want. This marketplace is called a stock exchange, and it is where buying and selling stocks happens in an organized and regulated way. A stock exchange is not a single building, but a system that connects buyers and sellers. In the past, trading happened face-to-face on trading floors, where brokers shouted orders and made deals with hand signals. Today, most trading is done electronically through computer networks, allowing people from anywhere in the world to participate. Some of the most well-known stock exchanges include the New York Stock Exchange, often called NYSE, which is one of the largest and oldest in the world. Another major exchange is Nasdaq, which is known for listing many technology companies such as Apple, Microsoft, and Tesla. In Europe, the London Stock Exchange is one of the most important, with companies from different countries listed there. These exchanges provide the platform for investors and traders to buy and sell stocks quickly and efficiently. The main job of a stock exchange is to ensure that trading happens smoothly and fairly. Without exchanges, buying and selling stocks would be chaotic, with no guarantee that buyers could find sellers or that prices would be fair. The exchange acts as a referee, making sure all transactions follow strict rules. Every company that wants to sell its stocks on an exchange must meet certain standards, such as providing financial reports and following ethical business practices. This protects investors from fraud and gives them confidence that the companies they invest in are legitimate. Stock exchanges also help determine stock prices based on supply and demand. If many people want to buy a particular stock because they believe the company is doing well, the price of that stock goes up. If more people want to sell a stock because they think the company's future is uncertain, the price goes down. This process happens in real time, with prices constantly changing throughout the trading day as new information becomes available. News about a company's earnings, leadership changes, or major economic events can influence supply and demand, causing stock prices to rise or fall. One of the most important features of a stock exchange is liquidity, which refers to how easily a stock can be bought or sold without significantly affecting its price. Imagine trying to sell a rare item in a small town where very few people are interested in buying it. Finding a buyer could take a long time, and you might have to lower the price significantly to make a sale. Now, imagine selling the same item in a big city with thousands of interested buyers. You could sell it quickly at a fair price. This is what liquidity means in the stock market. A liquid stock is one that has many buyers and sellers, making it easy to trade at a stable price. The more liquid a stock is, the less likely an investor is to face problems when trying to buy or sell shares. Stock exchanges bring all these elements together, creating an organized system where companies can raise money, investors can grow their wealth, and the economy can function efficiently. Without stock exchanges, investing would be much riskier and more complicated. They provide the structure that makes the stock market work, ensuring fairness, transparency, and accessibility for everyone who wants to participate. Imagine walking into an auction where people are bidding on a valuable painting. At first, a few bidders are interested and the price remains low, but suddenly, more people recognize its worth and the bidding war begins. As more buyers compete, the price soars. Now imagine the opposite scenario. If the painting has flaws or fewer people want it, the price falls because no one is willing to pay as much. This is the same way stock prices move, driven by how many people want to buy or sell a particular stock. This constant movement of stock prices is what makes the stock market so dynamic and unpredictable. The main reason stock prices go up or down is supply and demand. If more people want to buy a stock than sell it, the price rises because buyers are willing to pay more to secure their shares. If more people want to sell than buy, the price drops because sellers lower their prices to attract buyers. This balance between buyers and sellers happens every second of the trading day, making stock prices fluctuate continuously. A stock that is in high demand can see rapid price increases, while one that loses investor interest can experience sharp declines. Company performance also plays a crucial role in determining stock prices. When a company makes strong profits, expands its business, or releases successful products, investors feel confident about its future. This confidence leads more people to buy the stock, pushing its price higher. Every few months, publicly traded companies release earnings reports that show how much money they have made or lost. If a company's earnings are higher than expected, the stock often rises because investors believe the business is growing. If earnings disappoint, the stock usually falls because investors worry about its future prospects. Companies that show steady growth over time tend to attract more investors, leading to a gradual increase in stock prices. Beyond numbers and financial reports, stock prices are also influenced by human emotions. Investors do not always make decisions based purely on facts. They are often driven by fear, greed, and market sentiment. When stock prices rise quickly, people may become overly optimistic and rush to buy, believing they will continue going up. This can create bubbles where stocks become overvalued. On the other hand, when markets decline, fear spreads, and investors panic, selling stocks at a loss. This emotional reaction can cause stock prices to fall further than necessary, creating downturns that are not entirely based on a company's actual performance. Understanding this emotional cycle helps investors make better decisions rather than reacting impulsively to short-term market movements. News and world events can cause sudden changes in stock prices as well. A company announcing a major new product, merging with another business, or facing a lawsuit can all influence how investors perceive its future. Broader economic factors also play a role. Interest rate changes, inflation levels, government policies, and global trade agreements can shift market conditions. A strong economy usually leads to rising stock prices because businesses perform well and consumers spend more. However, if a country faces a recession, high unemployment, or a financial crisis, stock prices often drop as businesses struggle to maintain profits. Global events such as wars, natural disasters, and pandemics can create uncertainty, causing investors to pull back from the market and sending stock prices downward. Every movement in stock prices tells a story. Some stocks rise because of solid company growth, while others fall due to investor panic or economic downturns. The stock market is a living system, constantly adjusting to new information and shifting expectations. For investors, understanding these forces is key to making informed decisions and staying prepared for the ever-changing landscape of the financial world. Imagine you want to buy a share of a company, just like you would buy an item from an online store. In the past, people had to call their brokers, place orders through phone calls, and wait for confirmation. Today, technology has made the process much simpler, allowing anyone with an internet connection to buy and sell stocks in just a few clicks. However, behind this simple action is a complex system that ensures trades happen smoothly, prices are fair, and transactions are completed securely. To buy a stock, an investor needs access to a stockbroker. Brokers act as intermediaries between buyers and sellers, helping investors execute trades on stock exchanges. There are two main types of brokers. Traditional brokers provide personalized services, financial advice, and expert recommendations, making them ideal for those who want professional guidance. These brokers usually charge higher fees for their services. On the other hand, online brokers have revolutionized trading by allowing people to buy and sell stocks on their own, using digital platforms. These platforms provide tools, research reports, and real-time market data, making it easy for investors to manage their portfolios independently. With online brokers, trading has become more accessible, allowing people from all walks of life to participate in the stock market. Once an investor has an account with a broker, they need to decide how they want to buy or sell a stock. The most common way is through a market order, which means the trade will be executed immediately at the current market price. This method is useful for investors who want to buy or sell quickly without worrying about small price changes. However, stock prices fluctuate constantly, so the final price may be slightly different from what was expected. For those who prefer more control over the price they pay, a limit order is another option. A limit order allows an investor to specify the maximum price they are willing to pay for a stock when buying, or the minimum price they are willing to accept when selling. The trade will only go through if the stock reaches that price. This method ensures that investors do not overpay for a stock or sell for less than they want. But it also means the trade might not be completed if the stock never reaches the desired price. Stock prices are determined by supply and demand, but there is an important part of the trading process that helps match buyers and sellers. Every stock has two main prices at any given moment: the bid price and the ask price. The bid price is the highest amount a buyer is willing to pay for a stock, while the ask price is the lowest amount a seller is willing to accept. The difference between these two prices is called the spread. A narrow spread, where the bid and ask prices are close together, means there is high demand for the stock and it is easy to buy or sell. A wider spread indicates lower demand or higher uncertainty. When a buyer and a seller agree on a price, the trade is executed and the ownership of the stock is transferred from one person to another. Investors also need to be aware of the costs involved in trading. Brokers charge fees for executing trades, and these costs can add up, especially for those who trade frequently. Some brokers charge a commission on each trade, while others offer commission-free trading, but may include other hidden fees. In addition to broker fees, there may be small charges related to regulatory costs and exchange fees. Investors who buy and sell international stocks may also face currency conversion fees. Understanding these costs is important because they can affect overall investment returns. The process of buying and selling stocks is more than just clicking a button. It involves making informed decisions, choosing the right type of order, understanding how prices are determined, and being aware of costs. Whether someone is investing for the long term or trading frequently, knowing how the mechanics of trading work allows them to navigate the stock market with confidence and make better financial decisions. Imagine two people standing at the edge of a river. One is patiently building a sturdy bridge to cross it safely, while the other is trying to jump from rock to rock, moving quickly but taking the risk of slipping. Both are trying to get to the other side, but they are using completely different methods. This is how investing and trading work. Both involve buying and selling stocks, but the way they approach the market, the risks they take, and the rewards they seek are very different. Investing is like planting a tree and waiting for it to grow over many years. It is a long-term approach where people buy stocks and hold on to them for an extended period, sometimes for decades. The goal is to benefit from the gradual increase in a company's value over time. Investors do not worry about short-term market fluctuations because they believe that in the long run, strong companies will grow and their stocks will be worth more. Investing requires patience, discipline, and an understanding that markets go through cycles of ups and downs. Trading, on the other hand, is like trying to catch a wave in the ocean at just the right moment. Traders buy and sell stocks frequently, sometimes within minutes or hours, trying to make quick profits from small price changes. Instead of waiting for a stock's value to grow over years, traders look for short-term opportunities based on market trends, price movements, and news events. This requires constant attention, quick decision-making, and the ability to handle risk. While trading can lead to fast profits, it can also result in quick losses if the market moves in the wrong direction. Investors who take the long-term approach use different strategies to decide which stocks to buy. Some follow value investing, where they look for stocks that are priced lower than their actual worth. These investors study a company's financial health, earnings, and assets to find hidden opportunities. They believe that over time the market will recognize the true value of these stocks, and their prices will rise. Another approach is growth investing, where investors focus on companies that are expanding rapidly. These companies may not always be profitable yet, but they are increasing sales, developing new products, or entering new markets. Growth investors are willing to pay a higher price for stocks because they believe the companies will continue to grow and eventually generate large profits. Index investing is a simpler and less risky strategy where investors buy stocks that follow the overall market rather than picking individual companies. This is done through index funds, which include a mix of stocks from many companies. Because index funds spread risk across multiple businesses, they provide stable growth over time and require little effort to manage. Many people choose this strategy for retirement savings or long-term wealth building. Traders who focus on short-term movements use different strategies to make profits quickly. Day trading involves buying and selling stocks within the same day, trying to take advantage of small price changes. These traders do not hold on to stocks overnight because they do not want to be affected by unexpected news or market movements while they are not actively watching. Swing trading is slightly different because traders hold stocks for a few days or weeks, waiting for short-term trends to develop before selling. These traders use technical analysis, studying charts and patterns to predict when prices will rise or fall. They are not concerned with a company's long-term success, only its short-term price movements. Momentum trading is another approach where traders look for stocks that are already moving strongly in one direction. They buy stocks that are rising quickly and sell when the momentum slows down. This strategy requires careful timing, as stocks that rise fast can also fall fast. Both investing and trading come with risks and rewards. Investing is more stable because it relies on long-term market growth, but it requires patience and the ability to ignore short-term market fluctuations. Trading, while offering the potential for quick profits, carries higher risks because stock prices can change unpredictably. Many traders lose money because they make decisions based on emotions rather than strategy. Choosing between investing and trading depends on an individual's goals, risk tolerance, and the amount of time they can dedicate to managing their money. Some people prefer the steady, long-term approach of investing, while others enjoy the fast-paced excitement of trading. Understanding the differences between these two approaches helps individuals make smarter financial decisions and choose the path that aligns best with their needs. Imagine a person standing at the edge of a river, deciding whether to cross by stepping on stones. Some stones are large and stable, making them safer to step on, while others are small and slippery, increasing the risk of falling. The wider the gaps between the stones, the bigger the reward for reaching the other side quickly, but also the greater the chance of slipping. Investing in stocks works in a similar way. Every decision comes with a level of risk, and the potential reward is often linked to how much uncertainty a person is willing to accept. Risk and return are two sides of the same coin. When someone invests in stocks, they are putting their money into a company with the hope that it will grow in value. If the company performs well, its stock price rises, and the investor makes a profit. However, if the company faces problems or the overall market declines, the stock price can fall, leading to losses. The stocks of well-established companies with stable earnings tend to have lower risks, but they also offer moderate returns. On the other hand, newer companies or businesses in unpredictable industries can offer higher returns, but their stock prices can be much more volatile. This is why high returns almost always come with higher risks. An investor must decide how much uncertainty they are willing to accept in exchange for the possibility of greater profits. One way to manage risk is through diversification, which is the practice of spreading investments across different stocks instead of putting all money into one company. Imagine someone filling a basket with different types of fruits. If one type of fruit spoils, the person still has others to eat. But if they only had one type of fruit and it went bad, they would be left with nothing. Investing works the same way. If an investor puts all their money into a single stock and that company faces difficulties, they could lose a large portion of their investment. However, if they spread their money across multiple stocks from different industries, the chances of losing everything become much lower. Some stocks may rise while others fall, balancing the overall risk and providing a more stable return over time. Many people lose money in the stock market, not because they invest in bad companies, but because they make avoidable mistakes. One common mistake is trying to get rich quickly. Some investors rush to buy stocks that are rising fast, believing they will continue going up forever. However, stocks often experience ups and downs, and buying at the highest point can lead to losses when prices eventually drop. Another mistake is selling too early out of fear. When stock prices fall, some investors panic and sell their shares, locking in their losses instead of waiting for the stock to recover. Successful investors understand that markets move in cycles, and patience is often rewarded in the long run. Emotions play a powerful role in investing. Fear and greed can lead people to make impulsive decisions that hurt their financial goals. When stock prices rise, greed can make investors overly confident, leading them to take unnecessary risks. When prices fall, fear can cause panic, leading to rushed decisions that result in losses. The most successful investors learn to control their emotions and make decisions based on logic rather than feelings. They set clear investment goals, stick to a strategy, and remind themselves that short-term fluctuations are a normal part of the stock market. Investing in stocks offers the potential for significant rewards, but it also comes with risks. Understanding the relationship between risk and return helps investors make smarter choices. Diversification reduces the chances of heavy losses by spreading investments across different stocks. Avoiding common mistakes and staying disciplined can help investors build wealth over time. Managing emotions is just as important as analyzing stocks, because fear and greed often lead to poor decisions. Those who approach the stock market with patience, knowledge, and a clear strategy increase their chances of long-term success while minimizing unnecessary risks. Imagine owning a small part of a bakery that sells bread and pastries every day. As the bakery earns money, it has to decide what to do with its profits. It could use the money to expand by buying new ovens and hiring more workers, or it could share some of its earnings with the people who helped fund the business in the first place. In the stock market, this is exactly how dividends work. Some companies choose to distribute a portion of their profits to their shareholders as a reward for investing in them. This payment is called a dividend, and it allows investors to earn money simply by holding on to stocks. Not all companies pay dividends. Some businesses, especially newer or fast-growing ones, prefer to reinvest their earnings back into the company instead of paying shareholders. They may use the money to develop new products, expand into new markets, or strengthen their operations. Companies that are well established and generate consistent profits, such as those in industries like utilities, consumer goods, and banking, are more likely to pay dividends. These companies often have stable business models and do not need to reinvest all of their earnings to continue growing. By paying dividends, they attract investors who are looking for a steady source of income. Investing in dividend-paying stocks is a way to earn passive income, meaning money that comes in without having to actively work for it. People who invest in companies that regularly pay dividends receive payments at scheduled intervals, often every 3 months. Over time, these payments can add up, providing a source of income that can be used for daily expenses, reinvested to buy more stocks, or saved for the future. Some investors build entire portfolios focused on dividend-paying stocks, aiming to create a steady stream of income that can support them in retirement or supplement other earnings. Dividends are closely tied to a company's financial health, which is why investors pay close attention to earnings reports. Every few months, publicly traded companies are required to release financial statements that show how much revenue they have generated, how much profit they have made, and what their future outlook looks like. These reports provide valuable insights into a company's performance and influence investor confidence. When a company reports higher than expected earnings, its stock price often rises because investors see it as a sign of strength. If earnings are lower than expected, the stock price may fall as investors worry about the company's future prospects. There is a direct relationship between earnings, stock prices, and dividends. A company that consistently earns strong profits is more likely to maintain or even increase its dividend payments, making its stock more attractive to investors. As demand for the stock increases, its price tends to rise. On the other hand, if a company struggles financially, it may reduce or eliminate dividends to conserve cash. This can lead to a decline in investor confidence and a drop in stock price. Companies that have a long history of paying and increasing dividends are often seen as stable and reliable investments. Understanding how stocks generate income through dividends and how earnings reports impact stock prices is an essential part of investing. Some investors focus on finding companies with strong dividend records to build long-term wealth, while others analyze earnings reports to identify businesses with growth potential. Whether an investor is looking for steady income or capital appreciation, knowing how dividends and earnings work provides a clearer picture of how companies reward shareholders and how stock values change over time. Imagine a city where businesses are thriving, people have good jobs, and money is flowing through shops, restaurants, and markets. The energy is high, and there is a sense of optimism. Now imagine another city where stores are closing, people are struggling to find work, and the streets are quieter. The mood feels uncertain, and fewer people are spending money. These two cities represent the difference between a strong economy and a weak one. Just like people feel the effects of economic conditions in their daily lives, the stock market responds in much the same way. When the economy is growing, the stock market tends to rise, and when the economy struggles, stock prices often fall. Economic growth and the stock market are closely linked because companies rely on consumers and businesses to buy their products and services. When the economy is expanding, people have more disposable income, businesses increase production, and investors feel confident about the future. As a result, stock prices rise because companies are making more money and their future looks bright. Investors buy shares in businesses they believe will continue to grow, pushing stock prices even higher. The reverse happens when the economy slows down. If people start spending less, businesses earn lower profits, and investors become cautious. Stock prices begin to fall because the future suddenly looks uncertain. One of the biggest forces that influence both the economy and the stock market is inflation. Inflation occurs when the prices of goods and services rise over time, making everyday expenses more expensive. A small amount of inflation is normal and even beneficial because it encourages spending and economic growth. However, when inflation rises too quickly, it can hurt businesses and consumers. People find it harder to afford basic necessities, and companies face higher costs for materials, wages, and production. In response, central banks often raise interest rates to slow inflation. Higher interest rates make borrowing more expensive, which reduces spending and slows down business expansion. When this happens, stock prices often decline because companies earn less money, and investors worry about economic growth slowing down. Government policies also play a major role in shaping the stock market. When governments introduce tax cuts, invest in infrastructure, or provide financial assistance to businesses, the economy benefits and stock prices tend to rise. On the other hand, if the government increases taxes, imposes regulations, or reduces spending, businesses may struggle and stock prices can decline. Investors closely watch policy decisions, knowing that even a small change in tax laws or regulations can affect corporate profits and economic growth. The stock market does not always move in a straight line. It goes through cycles where prices rise for years, followed by periods where they fall sharply. When the economy slows down significantly, businesses make less money, job losses increase, and consumer spending declines. This is called a recession. And during these periods, stock prices often drop as investors anticipate lower company earnings. In some cases, a severe downturn leads to a market crash, where stock prices fall rapidly in a short period. Crashes often happen because of panic selling, where investors rush to sell their stocks out of fear, driving prices down even further. While market crashes can be frightening, history has shown that they are temporary. Over time, economies recover, businesses rebuild, and stock prices eventually rise again. Global events can also send shockwaves through the stock market. Wars, natural disasters, pandemics, and political instability create uncertainty, which makes investors nervous. When major disruptions occur, businesses may struggle with supply chain issues, labor shortages, or reduced demand for their products. Investors react by selling stocks, causing prices to fall. However, not all global events have negative effects. In some cases, they create new opportunities for businesses to grow. For example, during technological advancements, certain industries thrive as new innovations drive economic expansion. Understanding the relationship between the economy and the stock market helps investors make better decisions. Stock prices reflect what investors believe will happen in the future, and by analyzing economic trends, it becomes easier to anticipate how markets might react. While short-term fluctuations can be unpredictable, long-term economic growth has historically led to rising stock prices. This is why successful investors focus on the bigger picture, knowing that the stock market is deeply connected to the overall health of the economy. Imagine walking into a large stadium filled with thousands of people. Instead of trying to count every person in the crowd, you look at a few sections to get an idea of how full the stadium is. This is how stock market indices work. Instead of tracking every single stock, they group together a selection of important companies to provide a snapshot of how the overall market is performing. These indices act like measuring tools, helping investors, businesses, and governments understand the direction of the economy and financial markets. A stock market index is a collection of selected stocks that represent a particular market or sector. There are many different indices, each designed to track a specific part of the stock market. The S&P 500 is one of the most well-known indices and includes 500 of the largest publicly traded companies in the United States. It provides a broad view of the overall stock market because it includes companies from various industries such as technology, healthcare, finance, and consumer goods. When the S&P 500 rises, it usually means that most major companies are doing well, and when it falls, it signals that investors are concerned about economic conditions. Another widely followed index is the Dow Jones Industrial Average, often called the Dow. Unlike the S&P 500, which includes 500 companies, the Dow tracks just 30 large corporations. These companies are chosen because they are leaders in their industries and have a significant impact on the economy. The Dow is one of the oldest stock indices and is often used as a quick reference for how the stock market is performing. When people hear that the market is up today, they are often referring to the Dow. However, because it includes only a small number of companies, it does not always provide a full picture of the entire stock market. The Nasdaq Composite is another important index, mainly focused on technology companies. It includes thousands of stocks, with a large portion coming from the technology sector. Companies like Apple, Microsoft, and Google are major components of this index. The Nasdaq is often used to measure the performance of tech stocks, and when it rises, it is a sign that the technology industry is strong. If it declines, it suggests that investors are cautious about the future of tech companies. Stock indices serve as important tools for tracking market trends. By looking at the movement of an index over time, investors can understand whether the market is growing or slowing down. If an index has been rising steadily, it indicates that businesses are expanding, profits are increasing, and investor confidence is high. If the index is falling, it may suggest economic challenges, declining corporate earnings, or uncertainty among investors. Governments and financial experts also use indices to assess economic conditions and make policy decisions. Different indices use different methods to calculate their values. Some are market-weighted, meaning that companies with larger total stock values have a bigger influence on the index. The S&P 500, for example, is market-weighted, so a large company like Amazon or Tesla has a greater impact on its movement than a smaller company. Other indices, like the Dow, are price-weighted, meaning that stocks with higher individual prices have a bigger effect on the index, regardless of the company's actual size. This means that a company with a high stock price can move the Dow significantly, even if it is not one of the largest companies in the market. Many investors choose to invest in index funds instead of buying individual stocks. An index fund is a type of investment that automatically follows a stock market index, such as the S&P 500. Instead of trying to pick individual stocks, investors in index funds own a small portion of all the companies in the index. This approach provides diversification, reducing risk by spreading investments across many businesses. It also requires less effort because index funds are managed automatically and do not require constant buying and selling of stocks. Over the long term, index funds have historically provided strong returns, making them a popular choice for people who want to grow their money steadily without the complexity of selecting individual stocks. Stock market indices simplify the process of understanding market performance. They provide a clear view of how companies are doing, help investors make informed decisions, and serve as benchmarks for the overall economy. Whether someone is an experienced investor or just starting out, understanding indices is essential for navigating the stock market with confidence. Imagine standing on a beach watching the waves roll in and out. Sometimes the tide is high and the water rises, covering the sand. Other times the tide is low and the shoreline stretches far into the distance. The stock market moves in a similar way, going through cycles of rising and falling over time. Just like the ocean's tides are influenced by the moon and the weather, stock market cycles are shaped by economic conditions, investor emotions, and business performance. Understanding these cycles is important for investors because it helps them make better decisions and avoid reacting out of fear or excitement. When the stock market is rising for a long period and stock prices keep going up, it is called a bull market. In a bull market, investors feel confident, businesses are growing, and the economy is strong. People are willing to buy stocks because they believe prices will continue to rise. Companies expand, hire more employees, and report higher earnings. The optimism spreads, and more investors enter the market, driving prices even higher. This cycle can last for months or even years, creating an environment where investing feels easy and profitable. But just as the tide does not rise forever, stock prices do not go up endlessly. At some point, the market begins to slow down. If stock prices start falling and continue declining for a long time, it becomes a bear market. In a bear market, investors grow cautious, businesses struggle to maintain profits, and economic growth slows down. People become more reluctant to buy stocks, and some start selling their investments out of fear that prices will fall further. This leads to a downward spiral, where falling prices cause more selling, pushing stocks even lower. Just as a bull market can last for years, a bear market can also stretch over months or longer before the cycle begins to reverse. Market cycles do not happen randomly. They go through different phases, just like the changing seasons. The first phase begins when the market is recovering from a previous downturn. In this stage, stock prices are still low, but some investors start buying because they believe the worst is over. As more people gain confidence, the market enters a growth phase, where stock prices rise steadily. Businesses expand, economic conditions improve, and investor optimism increases. This leads to the peak phase, where stocks reach their highest point, and everyone feels confident about the future. However, when stock prices rise too quickly and become overvalued, the market enters the decline phase. Investors start selling stocks to lock in profits, and the market begins to lose momentum. If economic conditions weaken or uncertainty spreads, the decline can turn into a full bear market, completing the cycle. Eventually, prices fall low enough that new investors start buying again, and the process begins anew. Throughout history, the stock market has gone through many cycles of growth and decline. Some of the most famous market crashes, like the Great Depression in the 1930s or the financial crisis of 2008, caused deep economic downturns that took years to recover from. In these periods, stock prices collapsed rapidly, and many people lost significant amounts of money. However, history has also shown that after every major decline, the market has eventually recovered and reached new highs. The crashes of the past were followed by strong periods of growth, proving that market cycles are a natural part of investing. Long-term investors understand that market cycles are unavoidable, and they develop strategies to stay profitable even during downturns. Instead of reacting to short-term price movements, they focus on the bigger picture, knowing that stock prices tend to rise over long periods. They diversify their investments across different industries and avoid making emotional decisions when prices drop. Instead of panicking during a bear market, they see it as an opportunity to buy stocks at lower prices, just as a smart shopper looks for discounts during a sale. Market cycles are an essential part of how the stock market operates. They remind investors that prices will not always rise, but they also reassure them that downturns do not last forever. Those who stay patient, invest wisely, and understand the rhythms of the market are more likely to build wealth over time and navigate the ups and downs with confidence. Imagine a time when investing in the stock market meant dressing in a suit, making a phone call to a broker, and waiting for hours or even days for a trade to be completed. Investors had to rely on newspapers for stock prices and financial news, and every decision required careful planning with limited information. Today, technology has transformed the way people invest, making trading faster, easier, and more accessible than ever before. What once required a phone call to a brokerage firm can now be done in seconds with a few taps on a smartphone. The stock market, once dominated by large institutions and professional traders, has opened its doors to anyone with an internet connection. Online trading has changed the way people buy and sell stocks. Brokerage firms that once charged high fees for every trade have been replaced by online platforms that allow investors to trade at little or no cost. Instead of needing a middleman to execute a transaction, individuals can now place their own trades in real time. This shift has made investing more convenient, allowing people to react quickly to market movements and manage their investments from anywhere. With the rise of mobile apps, even those with little experience can enter the stock market with ease. Many platforms offer educational tools, research reports, and even automated investment strategies, making it simpler for beginners to learn and participate. One of the biggest changes in modern trading is the use of algorithms, which are sets of instructions that computers follow to make trading decisions. Algorithmic trading has become a dominant force in the market, with computers executing thousands of trades per second based on pre-programmed strategies. These systems analyze market data, identify patterns, and execute trades at speeds no human can match. By reacting to price changes in milliseconds, algorithmic trading helps create liquidity, ensuring that stocks can be bought and sold smoothly. However, it can also contribute to sudden price swings, as automated systems respond instantly to news, economic data, or changes in investor sentiment. While algorithmic trading has made markets more efficient, it has also introduced new challenges, as unexpected technical glitches or rapid sell-offs can lead to increased volatility. Social media has also become a powerful force in the stock market. In the past, market trends were shaped by professional analysts and financial institutions, but today, information spreads instantly across platforms like Twitter, Reddit, and YouTube. Retail traders, who are individual investors rather than large financial firms, have gained more influence by sharing ideas, strategies, and stock recommendations online. Some communities have even organized large-scale buying efforts, driving up stock prices and challenging traditional market expectations. The sudden rise of certain stocks due to online discussions has shown how social media can shift market dynamics, sometimes leading to sharp price increases or declines within days. While this has given more people the confidence to invest, it has also introduced risks, as stock prices driven by online trends can be highly unpredictable. Beyond traditional stocks, technology has also paved the way for new types of investments, including cryptocurrencies and digital assets. Unlike stocks, which represent ownership in a company, cryptocurrencies are digital currencies that operate on decentralized networks. Bitcoin, Ethereum, and other cryptocurrencies are not traded on traditional stock exchanges, but have gained attention as alternative investments. Some investors see them as a store of value similar to gold, while others view them as speculative assets with high potential rewards and risks. The rise of cryptocurrency trading platforms has created a separate market that operates around the clock, independent of stock market hours. Although cryptocurrencies are not technically part of the stock market, they have become increasingly connected to traditional finance, with some publicly traded companies investing in digital assets and financial institutions offering cryptocurrency-related services. Technology has completely reshaped the stock market, making investing more accessible, automated, and influenced by digital communities. The ability to trade from anywhere, the speed of algorithmic transactions, the power of social media, and the rise of new digital assets have changed the way people interact with financial markets. While these advancements have created new opportunities, they have also introduced new risks, requiring investors to stay informed and adapt to a rapidly evolving landscape. The future of trading will likely continue to be shaped by innovation, as technology continues to redefine how people invest and manage their financial futures. Imagine standing at the edge of a vast landscape, watching as new roads are built, new cities rise, and new technologies change the way people live. The stock market is like this ever-changing landscape, constantly evolving as the world moves forward. The way people invest today is very different from how it was done a few decades ago, and in the years ahead, even more changes will reshape the market. Advances in technology, shifting values, new government policies, and the participation of younger investors will all play a role in shaping the future of stock trading and investing. Artificial intelligence is becoming one of the most powerful forces in stock trading. Computers are no longer just tools for executing trades. They are now making decisions, analyzing market trends, and predicting price movements with incredible accuracy. AI-powered systems process vast amounts of data in seconds, identifying patterns that humans might miss. These systems learn from past market behavior and adjust their strategies in real time. Large financial institutions are already using AI to automate trading, manage risks, and optimize investment portfolios. In the future, AI may become even more advanced, making the stock market more efficient, but also raising questions about whether human traders will still play a central role. As AI continues to shape investing, understanding how these systems work will become essential for anyone who wants to succeed in the stock market. Beyond technology, a shift in values is also changing the way people invest. Many investors today are no longer just focused on profits. They want their money to support companies that align with their beliefs. Sustainable investing, also known as ESG investing, focuses on companies that prioritize environmental, social, and governance factors. Investors are looking at how businesses treat their workers, how they impact the environment, and whether they operate ethically. Companies that focus on sustainability are attracting more investment, while those that ignore these issues may struggle to gain investor confidence in the future. Ethical investing is not just a trend, it is becoming a major force in the market. As more investors demand transparency and accountability, businesses will need to adapt to this new reality. Government policies and regulations will also play a major role in shaping the future of the stock market. When governments change tax laws, impose new financial regulations, or introduce policies that affect businesses, stock prices can rise or fall depending on how investors react. Some regulations aim to protect investors and prevent financial crises, while others may create challenges for certain industries. For example, stricter environmental laws could affect energy companies, while new tax policies could influence corporate profits. Governments are also exploring ways to regulate newer financial markets, such as cryptocurrencies, to ensure stability and prevent fraud. Investors who stay informed about policy changes will have an advantage in understanding how regulations might impact their investments. For new investors, preparing for the future means learning how to navigate a market that is becoming more complex. Investing is no longer just about picking stocks and hoping they go up in value. It requires understanding new technologies, recognizing global trends, and staying informed about changes in economic policies. Education will be more important than ever as markets move faster and information spreads instantly. Successful investors in the future will not only need to understand traditional stock market principles, but also adapt to innovations that are shaping the financial world. The future of the stock market is filled with opportunities and challenges. Artificial intelligence will make trading more precise. Sustainable investing will change the way companies operate. Government policies will shape market conditions, and new investors will need to be more informed than ever before. As the stock market evolves, those who embrace these changes, stay curious, and continue learning will be the ones who thrive in this new era of investing. Imagine standing at the foot of a mountain, looking up at the peak in the distance. The climb ahead may seem challenging, filled with twists and turns, moments of uncertainty, and stretches of steady progress. But with each step forward, the journey becomes clearer, and the path more familiar. This is what investing in the stock market feels like. It is not about rushing to the top as quickly as possible, but about taking one step at a time, learning along the way, and building the skills and confidence to navigate any terrain. Throughout this journey, several key lessons have emerged. The stock market is not a place of random luck, but a system driven by businesses, economies, and human behavior. Stock prices rise and fall, but over time, the market rewards those who invest wisely and remain patient. Risk and reward go hand in hand, and the best investors learn how to manage uncertainty rather than fear it. The importance of diversification cannot be overstated, as spreading investments across different stocks reduces the impact of unexpected downturns. Emotional decisions often lead to losses, while discipline and long-term thinking create real financial growth. Knowledge is the most valuable asset an investor can have, and those who take the time to understand the market stand the best chance of success. Starting the investment journey does not require vast amounts of money or expertise. Anyone can begin with small, thoughtful steps, focusing on learning rather than trying to make quick profits. The biggest advantage a new investor has is time. The earlier someone starts, the more they can benefit from the power of compound growth, where even small investments multiply over the years. Success in the stock market does not come from chasing trends or trying to predict every price movement. It comes from making well-informed choices, staying patient, and allowing investments to grow over time. The world of investing never stands still. Technology continues to change the way stocks are traded, new industries emerge, and global events reshape market conditions. This means that even the most experienced investors must keep learning. Staying informed, adapting to new information, and being open to new strategies are what separates successful investors from those who struggle. The stock market is not something to master in a single day. It is a lifelong process of understanding, adjusting, and improving. More than anything, investing is a journey, not a sprint. It is not about getting rich overnight, but about creating a path toward financial security and independence. There will be moments of uncertainty when the market fluctuates, but those who stay the course and trust in their strategy will see the rewards over time. Investing is not just about numbers on a screen. It is about building a future, achieving goals, and gaining the freedom to live life on one's own terms. With patience, knowledge, and the right mindset, anyone can become a smart investor and take control of their financial future. The mountain may be high, but every step forward brings the summit closer, and the view from the top is worth the climb.